Hello, this is Dale. In this mini course, I'm going to be talking about the basics of options, the definition of an option, what's an in the money, at the money, and out of the money option. Before we move further, you need to know the basics of an option, because an option is a vehicle that is going to allow us leverage over just purchasing stock directly. Let's say it's a beautiful summer day and you want to buy some land with a farm on it, and you stop by and you see this beautiful acreage for sale. And you go up and ask the farmer, well, what's the value? What's the value of this land? And he says it's on the market for $1 million. Well, you think that's a reasonable price. But at this point in time, you don't have $1 million. So you have to talk to the bank. You have to get everything lined up. So you're not really sure you can swing this deal, but you sure do like this property. So you settle with the owner on an option to buy the land in 6 months for the $1 million. And for that right, you're going to pay the owner, the current owner, $5,000. Now that gives you 6 months to do your homework, look at your finances, and anytime between now and 6 months, you can come back to the farmer and say, okay, I want to exercise this option and go ahead and buy this for $1 million. The $5,000 that you paid the farmer is his. Now, the only difference between this scenario and the market is options are usually not taken all the way to expiration and exchanged for the stock. They're usually used as a vehicle to buy or sell the right to do this at a lower value than it would be to buy the stock. The actual definition is an option is the right, not the obligation, to buy or sell a stock, ETF, or index at a specific price on or before a specific date. If you think the market is going up, that is a call. You want to buy a call. If you think the market is going down, you want to buy a put. Now let's look below and realize that at the time I did this, the stock price on Apple was $118.88. You didn't have, now let's say you wanted to buy 100 shares, you don't have $11,888, but you can buy an option. You can go out, in this case 3 months, out to January, and buy a 115 call, or really any call that you choose, but this particular call is worth $6.50. Remember, there's 100 shares per contract, so you are buying the right to buy Apple stock at 115 anytime between now and the 3rd week in January. All options expire the 3rd week of the month that you have here. This is the expiration month. So you now are controlling 100 shares of Apple for $650 versus going out and buying 100 shares of Apple stock for $11,888. Now, this price that you bought it is called the strike price. Okay? And at this point, it is below the 118, so there is real value to this option. There is intrinsic value or real value of $3.88, the difference between the 118.88 and the 115. The rest is time value. You're paying $2.62 to the owner of the Apple stock for the right to exchange that between now and the third week in January. As time goes by and we get closer and closer to that third week in January, this time value or this portion of the premium will decay to the point at expiration this will be zero. There will be no more time value in this option. So if nothing happens, if it stays at $118.88, it will continue to have real value of $3.88, and your option will only be worth $3.88 because this time value has eroded. Okay, so on November 24th, the Apple stock is worth $118.88. The intrinsic value is $388. Time value is $262 for a total premium of $6.50. Let's take a look 1 month later and say, well, what would it be worth if Apple stock is up 10%? Well, if it's up 10%, that would mean Apple stock would be selling about 130. And I've rounded this off. So the intrinsic value is the value of your option, the value of the stock minus the value of your option, or $15 at this point. Now the time value, since it's elapsed 1 month, the time value has decayed from $2.62 to $1.05. But the total value, the total premium of this option is now $16.05. And this is how people use options. They don't hold this till expiration. Most of the times they don't hold this to expiration and exchange it for Apple stock. They will simply, if it goes up, they will simply sell for $16.05 something that they bought for $6.50. Now roughly that's about a 3x increase in value. 300% increase in value. The stock has gone up 10%. That's the leverage that you get, and I'll talk more about that on a later mini course. Now let's say Apple goes down 10%, or roughly to about $106. Well, at that point in time, you have a 115 call, and the value of the stock is 106, so there is no real value. And at the same time, it's 1 month later, your time value has decayed. So if it's gone down 10% to 106, your $6.50 option is now only worth $1.05. Okay? Couple things to note here. One, the only thing you can lose is the $6.50. You can't lose any more than that. So in a sense, if you control your risk management and you control the amount of money you're investing in any given strategy, in any given stock at any given time, you can only lose the amount that you're investing. And that's kind of nice because you are controlling the risk. and at the same time you have unlimited return. Now, let's take a look at the terms at the money, in the money, and out of the money. Remember, our example is November 24th. We're using Apple, and it was trading at 118 per share. So a strike price right around 118.88, or let's, for Apple we rounded off in fives. So 120, a strike price of 120 would be called at the money. At the money. Now, anything below that would be called in the money, because in the money means it has real value. It has intrinsic value. Anything above that means if you have an Apple strike price of 130 and the value is 118, there is no value. The only value you have is time, and that's called an out of the money option. These will be cheaper. These are more expensive. As the stock moves up, these will gain in value by intrinsic, plus over here it's going to gain a little bit, but not as much, because it's not really in the money yet. It's got to be in the money for it to have that intrinsic or real value. Now, to go a little further, currently this is the value of the different strike prices for the Apple stock. At 120, or at the money, the premium is going to be $3.58. Now, if you start going out of the money, the only value it's going to have is time value. The further out of the money you have, the less value it will have, because the probability of it gaining, getting to the point where it's at $135 is pretty small. Therefore, the value of this is pretty small. However, a lot of people, not a lot of people, but some people will actually buy a 135 call because it is so inexpensive, thinking that Apple will go from 118 to 135 and above. And if it does, you can see that the leverage is tremendous because this was so inexpensive. On the other hand, there is less risk by buying an option that's in the money, because it has an intrinsic value, and you're not going to lose that intrinsic value unless the stock takes a tumble, at which point you can choose to just exit. You can exit at any time. Okay? At the money, in the money, and out of the money. Now, this is just a screenshot I took off of my Thinkorswim platform. I'm not associated with Thinkorswim, but I think it's one of the best trading platforms out there. Not only does it have tremendous graphics, tremendous information, you can get very low commissions. This is a self-directed trading platform that you can go in and not only look at the charts, but then execute the trades. This is a typical option chain, and what we're looking at is a January option for AAPL, or Apple. This will expire the third week in January, and you can see this is an at the money, okay, the 118.58, and over here you can see the bid and the ask. Okay, you're going to buy at the ask and sell at the bid. The difference between these two is what the floor traders how they make their money. Now, I always tell my people to go in at the midpoint to make your trade. In other words, go in at about let's call it, 432, and put your trade in. Most times the floor traders will accept that, and you have saved quite a bit. It's worth going in at the midpoint, and Thinkorswim makes it very easy to do that. Now, on this side, you can see the calls. These are all the calls. On this side, you can see all the puts. You can see the open interest, the number of contracts that are open. This is a delta. Delta is basically, if the delta is 0.55, what that means is for every dollar decrease on the stock, the put option will increase 55 cents. Okay? These on the call side are in the money. This is at the money. This is out of the money. On the put side, it's just the opposite. Anything below the 120 is in the money. This is at the money, and these are out of the money. And that's the end of this mini course on option basics. I hope you enjoyed it. There's more mini courses, so go ahead and continue your learning at this time. Bye-bye now.